So hello everyone. Um, Welcome to the webinar of tonight, the MSc in Finance Management webinar series, Digital Disruption and Future of Finance. I'm Phoenix, the External Relations Officer from the University of Manchester East Asia Center. Tonight, we have students and alumni and the prospective students from many regions, including Hong Kong, Singapore, Japan, Malaysia, Korea, and so on. So you may now see on the screen is the night rundown. We will have 4 speakers sharing their insight in different areas of fintech and the future of the finance industry. After their sharing, we will have the panel discussion and the Q&A part. So if you have any questions during our speaker sharing, please feel free to use the Q&A function in the Zoom function bar in the bottom of your Zoom screen. And we will also have a short introduction in our new MSc in Finance Management program after the Q&A sessions. Okay, so tonight we are honored to have 4 gentlemen to be our speaker. We have Professor Ismail, Mr. Eric Chen, Mr. Patrick Vizzone, and Mr. William Chen. So on the top left, we have Ismail. Ismail is a senior lecturer in banking in Alliance Manchester Business School, University of Manchester. He is also one of the module leader in our Global MBA program and advisory of many MNC and private bank. Next, we have Mr. Eric Chen, the Chief Public Mission Officer from Cyberport, Hong Kong. Eric is professional in many areas such as business development, partnership development, and consultants. So Cyberport Hong Kong is a fintech hub in Hong Kong, and many startups have their headquarters inside Cyberport too. Moving onwards, we have Mr. Patrick Vizzone, Head of Coverage Hong Kong and Head of Food Beverage and Agribusiness International at Australia and New Zealand Bank. So beside his role in ANZ, Patrick is also a board advisory of the Ag Funder and an investor in startup companies. Last but not least, we have Mr. William Chen, Director of Visa. William is now leading a large team in Asia Pacific, Central Europe, Middle East, and Africa. He is also a seasoned banking professional and familiar with the areas like cross-border payment transitions and digital platforms. So we are very grateful of all our speakers spent a lot of time to prepare for tonight's speakers. And now I will pass the stage to Ismail, our first speaker of this webinar.
Right. Thank you, Phoenix, and welcome everyone. I will share my screen with you now. Right, hope you can all see it. I mean, first of all, I'm sure there are alumni who I taught in the past, so it is, I can't see your faces, but I can feel you, the enthusiasm. So thanks our Singapore and Hong Kong centers to do this innovative collaborative work in East Asia. So it's great to see under these difficult times that our global centers find innovative ways of promoting education. So, and then those of you who are planning to join the programs, and then welcome to you all. So I'm quite excited to be presenting in this kind of format, and also being joined by ex-students who will be talking. I will talk today about the macro picture of future finance. So I'll start by identifying 2 irreversible trends in finance, and those trends I call a digital turn, which we identify with fintech and then digital finance, but also an ethical turn, increasing role of ESG criteria in financing companies, and also asset managers, fund managers, and banks increasingly taking environmental, social, and governance as an important criteria in financing companies. Because we always need to understand the history to be able to guess what's going to happen in future. But these two forces are irreversible, because we have technological development. As you can see here, I identify three forces that shape digital turn. The second one is the most obvious. We have innovations in digital technologies, which are shaping both back office and the front office of financial institutions. But we've also seen mobile banking as a major delivery channel for financial institutions. So we've evolved from branches to internet banking, and now mobile banking, especially in China. Ownership of mobile phones and then financial decisions being made on mobile phones have transformed the delivery of financial products. So that's the obvious one. But there are less obvious ones, but equally important: regulatory support, because the development of fintech, especially after the 2007 crisis, and we shouldn't forget the 2007 crisis in the US, the center of finance, financial knowledge, and then in Europe, was very important. It was very disruptive. It required a government support and also central bank support, which continues to this day. So after that, especially in Europe, open banking regulation allowed banks to open up their data to new startups in fintech. That's very important. And it has been adopted in other countries as well, like Singapore and then Hong Kong, as major financial centers in Asia have been very innovative in that sense, to have fintech and digital finance flourish in those two financial centers. But it's very important that non-banks, digital startups could have access to data of banks, which incumbent banks were not really very good at using for various reasons. I'm sure these things will be, but regulatory support is important, as we have seen with the Ant Group in China, how regulators, they wanted to shape digital finance to help the real economy in China. And I think there are interesting lessons to learn. But in the rest of the world as well, like in the US, they want to give federal charter to fintech companies to operate nationwide, because scale is important to be able to compete with banks. And thirdly, that's my research interest as well. Narratives, stories are always important in banking and finance, and they can influence valuation. So fintech startups have benefited from narratives and stories that they're going to beat the big banks and the future is all digital, which is true, but they tend to over-exaggerate the timing of the impact of a digital innovation on on banking. We should never forget, in finance, in economics, size is important. And then big banks have big capital, big pockets. So we cannot ignore the non technological strengths. But nevertheless, startups benefited valuations that the banks couldn't get in the stock market. Now, this is very important because this is also a risk that needs to be managed, as I will talk later how Wirecard in Germany failed. It was a big fintech company, but its power came from its valuation in the stock market in Germany, because at some stage the value of Wirecard, just because it had a nice story narrative that was going to disrupt banking, its valuation in the stock market in Frankfurt was higher than the likes of Deutsche Bank and Commerzbank, which were much bigger in assets and revenues. So we need to understand these to guess how things will develop. Ethical turn, obviously the forces that influence ethical turn, financial crisis in 2007, as I said, has been very important. And governments spend lots of money in the US and in Europe to save big banks. So the social purpose in banking has become very important. So what does finance do to create jobs, to create a growth in the economy, and to serve the society rather than making banks successful on their own, in size, in profits, etc. And the second development is we have seen increasing inequality globally, especially in the US and then in Europe. But at the same time, we have seen the growth of these very rich corporations like Apple, Amazon, Microsoft, and there has been criticism that they're not creating enough high-wage jobs and they're not paying enough tax. So that's another social sort of pressure on companies, but also as the ecological issues become important, the environmental cost created by especially fossil fuel companies have become important as well. And then we definitely see another irreversible trend that societies are becoming more sensitive to the climate and environment issues, and governments as well. Like the first meeting US President Biden had was with the Chinese president, and they talk about the climate risk and environmental risk. But all these things are happening, what I would call in an environment where there is financial fragility, because central banks, they saved the banks in 2007 crisis. They helped the economies to grow by lowering the interest rates, and then with COVID as well, they pumped huge quantities of money to protect companies from collapsing, not just banks. Now, is this sustainable? So it's also creating side effects like high levels of debt and an overvaluation of assets, real estate prices, and that's been acknowledged by the Chinese central bank as well, that in China they need to control real estate prices, but also in the US, the stock market. So we shouldn't forget that both digital and ethical turn with positive impact are happening in an environment where we have financial fragilities. So just to show, to support my view, this is the top picture, shows how now globally all countries have open banking to support fintech and digital finance so that they can compete with incumbent banks. It is all over the world. So this is an irreversible a trend. But we shouldn't forget the role of regulation here. Yeah. So regulators need to be smart. And the bottom slide shows how much money is going into into digital finance and then fintech startups. It's been increasing significantly over the years. Although 2020, after COVID, there has been some issues, but the overall trend is upwards. And the same thing with ESG. This slide shows how increasingly assets under management that goes to ESG related, well, using ESG as a criteria to invest. Again, since 2014, it's increasing, is expected to reach $60 trillion by 2024. Again, I mean, these will require different types of financial institutions, decisions, risk analysis. So these bring interesting challenges for financial institutions. Now, this is to show the fragility because central banks, especially after the COVID, has increased the amount of money in the economy at a very lower cost. And as a result, this is the US data, how stock market, especially in the US, has grown much faster than the growth in the real economy, and also the sales. So we have a disconnection at the moment between financial markets, valuations in financial markets, and the real economy, which will be a challenge for both ESG and digital finance, because some people are also talking about green bubble, because there aren't enough green companies to invest in, but asset managers are investing on those little number of green companies, and stock market valuations are going up. So again, we need to be smart how we make finance more environmentally and socially responsible, but that needs to be watched carefully. So this is IMF a study which shows basically the valuations in S&P 500 comes from a central bank support rather than the earnings of the companies. Again, that needs to be watched because it tends to create bubbles. And this is a Buffett bubble barometer, which says you know, we can expect 60% correction in the US stock market, but clearly everyone is concerned about the bubble in the stock market due to central bank support. Then with low interest rates, there's a risk of zombie companies, companies who borrowed and leveraged with low interest rates, but their earnings are not as high to be able to pay the debt back. So although we get excited about irreversible positive developments in digital finance, fintech, and then the ESG criteria, we shouldn't forget that there are still companies with some credit issues. So the incumbent banks and also fintech companies who are interested in lending need to be careful about credit risk. So we should not forget about credit risk. This is an example how in Europe, in Germany, as I mentioned before, Wirecard, which has been highly valued in the stock market, but then collapsed because of mismanagement and accounting irregularity. So we should never forget, especially in fintech and digital, these new competitive companies, they have to prove their business models. So as much as we are excited about technology, we shouldn't forget at the end of the day, you need to have a sustainable business model. Yeah, generating profits, covering your cost, and then we need to analyze those fintechs and digital finance companies on their business models as well as their technological superiority. Now here in digital finance, payments is very important, and this shows how in Asia it is commercially driven. As you can see, the blue side is mostly comes from the real economy, productive sector, whereas in the rest of the world, it tends to be more consumer driven. So that's the advantage of Asia in digital finance. It is more linked to the productive sector, and that's likely to be more sustainable, and then, as you can see by McKinsey calculations, profitable as well. And also, we shouldn't forget stock markets are important. And as you can see, US, the stock markets are bigger, but China, if we add up Shanghai, Hong Kong, and Shenzhen, they become the second largest, because to support your digital startups, you need a strong stock market. Now, Europe lags behind Asia there, and that's a concern for Europe. So for Europe to be able to create good fintech companies on a Europe-wide, they need to integrate their capital markets. Otherwise, having successful fintech companies like Clara, Adyen in Netherlands, you need good financial support to raise finance to grow. And then finally, I will emphasize digital finance, fintech, shouldn't be a game of technology. It should be real economy driven. It should help the growth of a real economy. So that's something to keep in mind. And regulators, they need to do smart regulation, and then they should be able to resist stock market valuations of digital finance. That's something very important, like the Wirecard in Germany was a good example, where politicians were mesmerized by the high stock market valuations without looking into the business model. Never underestimate the power of incumbent banks. As I said earlier, they have lots of capital, they have big pockets. And central banks, although they saved the financial system and the economy after COVID, but they have created fragilities, like I mentioned before. And ultimately, we talk about finance, green finance, ethical finance, digital finance, but we should never forget finance exists to support the real economy. And then that balance has been lost over the last 20 years. So that balance and then that reality needs to be remembered going forward for future of finance. Thank you.
So thank you, Ismail. So next we will have Eric.
Evening, everyone, and thank you for having me tonight. I'm Eric from Hong Kong Cyberport, and because I realized that actually a number of you are from various different geographies, and so I would like to just give you a quick introduction about who we are before I talk about the fintech landscape of Hong Kong, right? So basically, Cyberport is a digital technology hub of Hong Kong with around 1,600 startup and tech companies, of which 400 of them are fintech companies. That 400 fintech companies in our community already represent 2/3 of the market in Hong Kong, because there's around 600 fintech companies in Hong Kong. So the government actually has used Cyberport as a strategic partner to execute many of their fintech initiatives, and I'm going to talk about it later. So we are very close to the Financial Services and Treasury Bureau, who is the policymaker in Hong Kong, as well as the 4 regulators in the financial sectors, namely the Hong Kong Monetary Authorities, who regulates the banks, the SFC, the Security and Future Commission regulates, the securities companies, the Hong Kong Insurance Authority regulates insurance companies, as well as the MPF, Mandatory Provident Fund as authority. Right. So this is actually a bird's eye view of our technology park. Basically, we have a lot of office building, but apart from that, we have a lot of co-working space, in our campus, as well as shopping arcades. We even have our own hotel and movie theater. So from all these, we generate a lot of revenue, and all these revenues, subtract all the operating costs. The surplus is actually used to support the development of startup and innovation ecosystem of Hong Kong. So we're actually 100% owned by Hong Kong government, but we are actually set up as a commercial entity, which is in a very smart business model of self-sustaining, because we use our own profits, our own surplus, to support the innovative and technology sector. So this is where we are. We are 1,600 strong companies. And you can see that on the right-hand side, we have actually already groomed a number of unicorns, from our community. And the good news I want to share with you is, just 2 days ago, we have added one more unicorn to our community, which is called the Animoca Brands. It's a gaming companies, right, that has just been evaluated over $1 billion US. And the other two you probably have heard of is GoGo Van. Is now renamed as GoGo X. Is a van version of Uber, which is operating in many countries already. Klook is a travel agent, right? So we have many companies apart from fintech companies. So we track a lot. We track the fund raised by our community members, and you can see in the past 3 to 4 years, the atmosphere in investing into startup has grown exponentially. All right. So we register like 550 5.5 billion and 4.2 billion in the past 2 years. And this is basically just a glimpse about the different entrepreneurial program that we have. We provide a lot of subsidies, for people who want to land in Hong Kong and use Cyberport as a launching pad to go into China, as well as the neighboring countries. So if any of you have interested to in your own startup journey, do contact us. So okay, this is where we are focuses our energy on. It's basically 3 vertical clusters: fintech, smart living, and digital entertainment and esports. And we also put a lot of effort in the 3 underlying technology clusters, ABC, right? AI, blockchain, cybersecurity. So basically, to have to build a vibrant fintech community, we need a holistic ecosystems. Hence, we work with all the stakeholders that help to construct this ecosystem, including regulators I mentioned, as well as university, academia, and also industry partners, commercial firms, right? So I mentioned about the government using Cyberport as a vehicle to execute many of the fintech initiatives. I want to share with you a couple of them, which could actually shed some light on the active areas, of fintech are working on. Okay, one of the project that we are working on is you can see on the right upper corner is what we call the POC subsidy schemes. It's actually a proof of concept program that government subsidize the fintech to carry out some sort of pilot trial or proof of concept projects, as long as they get a sponsor from the financial institution like banks, right? So we are running it now. It's not a lot of money. We're talking about 150,000 Hong Kong, but I think it's really the endorsement of this kind of a trial or POC that gives a lot of values to fintech companies as well as financial institutions. So what we believe is actually this program, from idea generation to the execution to funding this investment, we actually work closely with the Bureau, the Financial Services and Treasury Bureau, to come up with it. And we have overwhelmingly positive response from the market. And what we've seen so far is there's a lot of interest in wealth management technology. The second most active type of project is regulatory tech. And I'm sure that people understand why, because of all these compliance requirements, especially in the banking sectors. And then the next 2 or 3 categories are insurtech, digital assets, and ESG and green finance, right? What Professor has been talking about, which is quite understandable because more startups are looking for more investment from impact investors that focuses on investing into ESG or green finance projects. Okay, so in terms of policy, you can see that Hong Kong regulators are trying to be a little bit more forefront. They have actually issued 8 virtual banking licenses in the past 2 years. And 2 of them are actually in our community, WeLab and Zhong'an International. What we have seen is obviously some of those all digital banks have promised a lot of new products and solutions and superior customer experience. Okay, I mean, they have yet to prove, their promises. As Professor was saying, bigger banks, also come up with their own digital version of banks. And some of those 8 virtual banks, they are actually backup, or actually they are part of a major banks. So what I've shown here is actually all digital banks. So it's yet to see, how it turns out. And then Hong Kong also has issued 4 virtual insurance license. 4 of all of them actually come from our community, and some of them try their best to come up with some, differentiation. Like One Degree, one of our community members, they started off offering pet insurance. You can buy insurance for your dogs and cats, right? So these are some of the innovations that they're trying to come up with. And then obviously, to build a good, fintech community, you also need a lot of talents. Hence, the government has also provided subsidies to create 1,000 new jobs, for fintech companies. And we are also the one that will help them to launch this program. We call it FAST because it was launched during the epidemic. So it was named as the Fintech Anti-Epidemic Scheme for Talent Development. Basically, the government subsidized $10,000 for maximum 12 months for each fintech companies to create 1 new job in the fintech areas. Okay, let's look at the fintech landscape. I mean, this is actually the landscape in our community. You can see that it's a wide spectrum of them. And probably some of you have heard that the People's Bank of China And the Hong Kong Monetary Authority has actually announced in 2020 the Wealth Management Connect program. That program means that residents in Hong Kong, Macau, and the 9 cities in the Guangdong province could actually carry out cross-boundary investment in wealth management products distributed by banks in the Greater Bay Area of China, which is the 9 cities plus Hong Kong and Macau. So logically, there's a lot of interest in wealth management, hence wealth tech is really booming. And then because of all these new regulations coming, the compliance requirements arising, RegTech is also one of the fastest growing clusters that we see. And also the HKMA, the Hong Kong Monetary Authorities, are also pushing a few initiatives. One of them is called the Cyber Security Fortification Initiative. Basically, they want to make sure that all these new financial products that are made available or possible because of the technology, they must have a fortified status before they are launched. Hence, they are pushing it. So they're creating a lot of demands on cybersecurity related technology that supports fintech, and which is extremely important. And then Professor talked about the data, the availability of fintech data. And HKMA is also pushing commercial data in the exchange. And we at Cyberport is also launching our sandbox, trying to get more people to share the data in whatever format they feel comfortable, so that people can test with it to create new financial products. There are various different technologies that can help them to mask sensitive data or even synthesize data. So basically the name of the game is to try more things for more innovations. And obviously the open banking and open API policies is also helping it, right? So I would like to bring to your attention that this Greater Bay Area, of China, is actually a market that no one, should basically ignore. We're talking about a Bay Area created by 9 cities in Guangdong province and Hong Kong and Macau that provide, kind of a 10 times the population of Hong Kong, because Hong Kong has 7.5 million populations, and we are talking about 70+ million of people. And because of all these policies that are already in place, like the Wealth Connect, we are seeing a lot of market potentials, which is so important, for the fintech development of Hong Kong. And as you know, that Hong Kong is already a leading international finance center. Hence, we want to make sure, people in Hong Kong, people in bank and finance sector would also embrace fintech and make sure Hong Kong stay competitive and stay relevant. And obviously, riding on the success in Hong Kong and potentially in the Greater Bay Area of China, we can also start exporting many of those fintech solutions and riding on the various different new policies that facilitate it, including the Belt and Road initiatives, right? So many of our startups are already operating in the Southeast Asia regions, where many of you come from, and this kind of a new policy about regional comprehensive economic partnership policy. I mean, obviously, it was just announced recently, and we are yet to see, the impact that it will bring, for the fintech communities. And also I'm sure that many of you know that China is leading in the central bank digital currency initiative, and hopefully Hong Kong, could be part of it. And we are going to see, a lot of development in that area. So I'll finish here, and probably we'll talk about more in the question and answer time. Thank you.
All righty. I guess that's my cue. Good evening, everyone. And thank you for joining tonight. And I'm especially pleased to be here, particularly in the presence of Professor Ertürk, who 20 years ago was lecturing me as a junior banker. And we sit here 20 years later together on a webinar. So it's great to be with you, Professor. Tonight, I'm going to talk a little bit about digital disruption and what the future looks like for financial services. Which spaces are being disrupted, talk a little bit about the players, and then also talk a little bit about the opportunities for those within financial services or even outside financial services, and a few things to think about as well. Look, one thing that really resonated with me were comments made by Professor Ertürk, and in particular around the environment, which at the moment is particularly challenging. You think of what we've been through as an industry over the past 12 years with the advent of quantitative easing and low interest rates, and the impact that has on profitability, and essentially as a financial institution, your net interest margin gets squeezed. And also, it's not just on the asset side, but the liability side of the balance sheet as well, where it's more difficult. For example, it's more challenging in terms of deposits and so on and so forth. We've also seen some deleveraging taking place as well, which really has an impact on volume, increased regulation and increased compliance costs, which will continue, and that impacts costs clearly. The other aspect there is it impacts competition, because it impacts the regulatory environment, impacts who can play in some circumstances as well. And then particularly where we sit in Asia, and particularly with the incredible rise of China, the competitive environment and the fact that there are far more competitors. You only have to look at the makeup of top 10 banks over the past 10 years to see how that dynamic has changed. So you've got all of this happening where the industry is undergoing enormous change from the macro environment. And now you have another overlay in terms of digital disruption, new entrants, and so on and so forth, and it makes for a fascinating, very enriching but challenging situation. So, pardon me, I'll talk a little bit about which spaces are being disrupted at the moment, and I'll try and give you a bit of a framework. So, firstly, spaces where there are large TAMs, total addressable markets, and so that's why we've seen a focus, for example, on retail banking, which is huge, but also on payments. You think of the trillions of dollars that go through payment systems, and also more recently into supply chain. You know, we had the example given of Wirecard as a recent failure. We've also seen Greensill, which was quite a spectacular failure in terms of supply chain, and that just goes to show you that, you know, even startups that are lauded over find it difficult when encroaching upon the domain of incumbents, which was, I think, a point that Professor made. Fragmentation is also an area where we're seeing disruption. That could mean fragmentation amongst concentration, which means it may be concentrated with a few players sort of at the top, but then there's a large swathe of the market which is still quite fragmented. High frictional costs or high transaction costs, and this is why we've seen disintermediation and we've seen substantial innovation in payments, in the same way that you think over the past 10 years, whether it's stock trading or foreign exchange trading, and how digital and innovation has influenced those areas as well. And where tech and innovation essentially can disrupt, and that means where you can get automation and scale. So as mentioned, we've seen that in payments with the advent of PayPal and now the major tech companies coming into the space. Why not? It's capital friendly. You can automate and get scale. You can start with a clean slate and not have any legacy systems. And tech companies in particular can leverage their user base. What's been even more interesting in the space is the emergence of investment banks in particular into transactional banking, and also into consumer and affluent private wealth banking as well. It's quite startling when you think that commercial banks and institutional banks have really been doing everything they can to migrate into that fee generative space that investment banks are in. Yet investment banks are starting with a clean sheet, with new platforms and with proprietary systems, and kind of backwards integrating into the payment space, the transactional banking space, et cetera, et cetera. So they are basically targeting profit pools that they don't participate in, which is extremely powerful when you think about the fact that they're starting with a clean slate. The other thing that we've also seen is an emphasis on partnerships and cooperation, which is really key. And we've seen a number of early adopters there paving the way. Apple is a really good one, where it's expanded its reach into payments with Apple Card using Goldman, which is powered essentially by Goldman Sachs. And then you see more choice, less friction, etc. And then the example of some of the Hong Kong partnerships between conglomerates, large tech companies, and financial services to build digital banks from scratch. So that leads quite neatly into who the participants will be going forward. I'm slightly talking my own book here. I love Professor's comments around don't underestimate the incumbents, and it's correct. It's not that the incumbents or the large banks can't innovate. We see the use of different tools like Agile and everything that goes along with that to foster innovation within a larger organization. I'll talk about that in just in a moment. So, and then you're seeing banks playing in different pools as well. So that's number one. Then you see the new entrants. You've got the larger tech companies, which basically own the interface and have very, very large reach and are able to leverage that. And then you've got newer, smaller startups. Some of them may be SMEs, all the way into emerging and emerged fintech players as well. They have an advantage, again, of starting with a clean slate, having no legacy technology, being innovative, agile, et cetera, et cetera. Now, one piece of advice I would give sort of to the industry and any of you that are looking for a career, particularly in the latter two buckets, whether you're looking at an established tech company or whether you're looking at a startup, we learned quite a bit through the GFC, and there's a reason that we have a higher degree of regulation within financial services. And I think the focus for emerging fintech companies and big tech that expand into this space really needs to be twofold. It needs to be on efficiency gains, and it needs to be on providing a fantastic customer service, and not, as we've seen in the past, regulatory arbitrage. And the reason for that is increasing regulation. Now, a lot of tech companies, their strength has been really built on moving fast and breaking things, and in some cases bypassing regulation. So when you think about Uber and the way Uber has revolutionized ride sharing, in some cases they operate really skirting the bounds of local regulation. When it comes to financial services, increasingly that won't work. Neither will, for example, monopolizing the interface with customers. And we've seen that quite spectacularly, I think, in China recently, with anti-monopoly policy being used more frequently, shall we say. And it's interesting to think that, going back 12 to 14 years ago, that regulatory arbitrage at that time was actually seen as an innovation in itself. And GE Capital, which is my old employer, was explicitly kind of held up as the poster child for deregulation. But that's something that in this world, particularly given one of the comments that the professor made, which I think was for a different matter, but you made the comment that finance exists to support the real economy. That means that it's there as a supportive role, not to be the driver itself. But the other thing to think about there in that comment is that it's systemically important, and when something is systemically important, it gets regulated. And when you have large entities that become too big to fail, importantly, they become highly regulated. So looking at the opportunities, I guess, for individuals, a couple of points I would make for those that are looking at a career in fintech or in banking, focusing particularly at digital. what are the skills you need? It really depends in some respects what, the area that you want to go into. But I think, number one, financial literacy is absolutely important. You don't, need to be at analyst level, but you need to be financially literate. Increasingly, those with engineering, advanced math, and coding skills is really important. Now, it doesn't necessarily mean you need to do the hard yards in coding, so to speak, but you need to be literate so you can maybe oversee a team. And it's interesting that in the environment I work in, we basically have 2 engineers that sit with the bankers to engineer our internal systems. And what they're doing using agile technology is interfacing with large development teams that sit in offshore centers, essentially. So that literacy there will definitely help. Also, we're seeing more in terms of human-centered design, which is extremely important in terms of designing, front to back systems and how that dovetails with the customer experience or the consumer experience. And then, if you dovetail that with language and cross-cultural skills, you're really then, set up for success. And the other thing I would say is increasingly we're looking for talent that can leverage different skill sets. If I personalize it, I started actually my career, believe it or not, in agribusiness. I moved from agribusiness into banking. And then along the way, I picked up some knowledge in technology as well. And so from a financial services standpoint, you can flex different muscles and you can be malleable, if you like. And that's something that we definitely look at in new talent for the bank. Individuals that are highly skilled and that can do different roles. For those within financial services that are listening to this and are looking at hiring individuals from outside, there's a few lessons that we've learned over the past couple of years as well. And there are 4. Basically, number one is, particularly if you're looking at someone with an engineering background or otherwise, you need to change the panel. You need to change the decision makers and not have the kind of traditional mode of hiring people in that respect. Secondly, you need to adapt the questions and you need to be looking for different things when trying to engage talent in this area to come work within a bank. You also need to, I think, expand the hiring pool. You can't use the same universities and the same pools where you would normally find talent. And finally, you also need to change expectations. And this is a generational shift that we're seeing in banking as well. You need to inculcate more flexibility, whether that's flexible working practices, working from home, which is really becoming an expectation. Change the work environment. Not everyone wants to sit in a cubicle. You may have shared workspaces that are more flexible, so on and so forth. So it really requires a bit of a rethinking of the workplace, and particularly in this environment, in a COVID environment, when we're also trying to inculcate social distancing and other things, that makes that all the more challenging. So I think I'll leave it there. So many other things that we could say, but perhaps we'll leave the rest of the time for the Q&A. Hope you found that interesting. Thank you.
All right. Yeah, so I guess it's my turn. Yeah, welcome everyone. So let me just share my slides. All right, evening everyone. So welcome. And yeah, so I'm William. Yeah, so yeah, excited to see everybody on the line here. So actually, I actually came from Hong Kong, so 12 years ago, and now I work in Singapore. So excited to see a lot of participants here, actually across diverse industries. So, and again, very welcome, yeah, to join us tonight. So actually, what I'm going to just share a little bit today is how AI is actually being applied in the financial industry and what are the more interesting use cases that we have observed now over the past few years. And yeah, so this is something that is quite interesting to observe because actually AI or artificial intelligence is now actually a topic that is close to a lot of financial institutions. And for example, there have been reports or surveys that talks about, like in Hong Kong, 90% of the banks, they adopt artificial intelligence in some way or to a certain extent. So, and actually AI itself can unlock potential value of the global banking industry up to $1 trillion. So it's actually something that is very worthwhile for the industry to look at. And indeed, just in Asia alone, right, the investment dollars on AI itself, it amounts up to tens of billions of dollars. So China is one that is leading in the investment of AI itself. So like around more than 40% of it coming from China, followed by Australia, Korea, Singapore, Hong Kong, and such. So it's actually a forever changing space. Yeah, there are new things, new ideas that's been coming up every now and then. So what I'm just going to share a little bit today is some of the use case that I've gathered that I think will be interesting for all to know, right? So first is on, you may see the credit decisions, so on the left. So using AI to make credit decisions or run underwriting approval is not something new. It's been there for quite some time. A lot of software fintechs has been doing that. So based on the credit score, based on the credit background, etc., to make a decision. So what is interesting is that now we are seeing this kind of algorithms or AI being used together with a payment scheme. So which is called buy now, pay later. So a lot of you may have like experience going to buy large ticket items, like going to Fortress in Hong Kong or going to Harvey Norman in Singapore. So the merchant is already partnering up with the banks, offering you interest-free installments. But now even on smaller ticket items like all these fintechs, they can also offer you installment payment schemes. So buy now, pay later is actually one of the fastest growing payment method, like in Singapore. So there are fintech names like Hula or Atomi. And what is interesting to know is that, of course, they gain fee from partnering with the merchants. They get late fees from the late payment as well. But what is interesting is that with the algorithm, based on that, what to approve, what to decline, there is just less than 1% of late payment fee accounting to the overall of the transaction volume. So, which means the algorithm behind that is very robust. It's interesting. So, to base on such kind of credit decisions to whether to approve a particular payment transactions or not. Well, okay. So on the next example, pretty much mature use case for AI as well is on risk and fraud management. So fraud surveillance is something that has been there using AI. It's actually very mature as well. So there have been like different kind of rule-based approach, like using your IP address location to track whether a particular transaction is of high risk, whether it's access from a potential scammer. And for example, even police force, like in Singapore, they actually partner up with all the banks as well, exchanging data on all these areas. And what is coming up and is gathering more attention in this area is what we call also the biometrics, behavioral biometrics. So this is going beyond just the statistic or static data. What it also gathers is that the system itself behind the scene, it actually learns how quickly are you typing on your keyboard, how often do you use a backspace or add on to your space, how quickly you move your mouse, how do you do your mouse click. So the AI, the robot itself is actually continuously learning your pattern. And from there, it make a decision to decide whether you are the actual account holder trying to access the system, trying to make a transactions, or is actually the scammer. Of course, scammer, they will also have their unique behavioral pattern behind the scene. All right. So this kind of deep learning or further leveraging on the AI technology is giving a second line of defense or further defense to the industry itself. Of course, like transaction patterns and like giving each individual transaction a risk score, like on the card network, Visa, MasterCard, we give each transaction a risk score. So to decide whether, to let the bank decide whether they should approve or reject such transactions. So all these schemes are there. Yeah, but with the continuous learning of this kind of information is getting more useful in this fraud detection area. And next, yeah, application on the payments technology itself. Yeah, something that I like to talk about. Yeah, because I specialize in payment itself. So, so on smarter posting, I think a lot of us may have experienced like spending on your cards when you are spending it overseas, or you're spending it on a foreign currency, like you buy $500 US using your card. You may have an estimate of how much is it equivalent in your Hong Kong dollar or in your Singapore dollar. And a few days later, you may find that actually in your statement yourself, you are getting charged of a different amount. So yeah, that's because the FX rate is different from the point that you are making the payment and at the point of the payment is getting settled. So the card network now actually is trying to give a customized score to help the banks to give a better user experience to their customer, to display better information to the customer. So each of these transactions will have a score that tells the bank how likely is it to have a consistent FX rate from the point of payment initiation to the point of the settlement to maintain the static rate. So the banks will know. So for example, if it is 80% likely, they will straight away display the final amount to the customer or to stay with that decision. So this is things that is in this area that is trying to give a better customer experience. All right. And other than that, there are also times that when banks or card issuers that may go disconnected, or yeah, internet is not working, cable is down, or just a momentary 10 seconds when you're swiping your cards. So traditionally, how it works is that when there is, because the bank will still needs to come in to say whether I approve or decline your card transactions, there was traditionally a rule-based approach, meaning that, for example, if the transaction is below certain threshold, or it is spent on a certain category of merchants, or it is a particular group of customers, then they will just approve the transaction, or otherwise they would make an offline decision to decline the payment itself. So what is getting smarter is that now with all the transaction data and payment transaction, that the network can continuously learn on it and find out more intelligence about it. It can actually cut down such false decline rates by half, by 50%. So it significantly improves the accuracies of what we call stand-in processing, meaning that a robot actually stand in on behalf of the bank when there is some disconnectivity to make a decision whether to approve or decline transaction. So this can actually brings up the accuracy from like historically like 60-ish% to over 90%. So things that a robot or AI can learn in this space is getting helpful in the payment areas. All right, and of course, with the institutions or with the system, with the company knowing more about us, I think as retail customers or as companies, we expect more of personalized service. So, for example, super app, they know when are you, when may you be making a payments, when you may be paying your bills, and then there will be automatic notifications showing up that you need to pay your bills. Or one example of use case is robo-advisors. So by answering some of the questionnaires, then they will automatically propose to you a certain investment portfolio. All right. So, and such personalized service doesn't just limit in individual consumers, so it's also getting applied in the commercial sector as well. So, for example, on the right-hand side here, you see that HSBC, actually OCBC as well, they partners with a fintech that is called Strands. All right. So what they do is that they help SME to do their cash flow forecasting. So SME has a very unique characteristics, right? So very different from the large corporates, which has a treasury teams that helps them with reconciling the account payables, receivables, and doing all the cash flow forecasting. An SME may be a businessman on the street running the business, trying to add on their revenue, talking to their suppliers. At the same time, they need to try and maintain their operating cash flow not to fall below zero. So with all this intelligence and partnership, the system of it can actually learn and picks up data of the companies like the credit history, the payable receivable history. Is it a peak season, low season for the company based on the products that they are selling? And then make a decision on the cash flow forecasting. Yeah, will we have sufficient cash flow in the next 1 month or 2 months? And will it go down to zero? Will there be a need to apply OD line in advance? So all this built into the bank's capability, and it's something that is interesting. Yeah, that is offering, I would say, a customized service, not just to the personal front, but also on the commercial front as well. And moving onward is, yeah, so this is actually the last 2 use cases I want to share. So first is applying AI more on the front office, on the customer engagement area. So chatbots or conversational AI, these are not news, but what is different is that now customers, they are expecting an omni-channel experience. So what it means is that for them to walk into the branch, talking to a bank staff, or to take a phone call, talking to someone, or typing a chat online, they are expecting that they will have similar experience. All right, like talking or communicating with a human. So actually, the technology right now is to the extent that some customer may not even realize that they are actually talking to a robot agent. Like, of course, it also depends on how well trained is the chatbot. So, right, and actually, majority of the case with the FAQ, company asked questions, they can give you instant customer service or answers on that. And to the extent of conversational AI, it's actually not just like limited on major languages like English or whatever. So even local languages, for example, what you see on the slide here, just recently in Thailand, the Bangkok Bank has launched a conversational AI engine, yeah, that allows the customers to talk to them in Thai. And it's not just getting account information, it allows them to also actually like initiate payments as well, which is something that previously you cannot imagine talking to a robot. All right, so yeah, AI, yeah, so you see it is helping on the front office, on the customer engagement angle, and of course, for the back office, middle office as well, there is a lot of this robotic automated process or automation as well. And actually using technology to help with like streamlining back office process is not new. Yeah, but with learning and understanding of all these different data and new patterns, that is something that is interesting. So like improving the straight-through processing STP for payment processing in the back office, auto repair of certain data as well. So what I want to call out here is actually OCR, okay, optical character recognition, is again not a new technology, but what has improved over the years is this accuracy. So it has been applied as far as like check truncation system, that OCR is being used to digitalize what the data on a check and then clearing the check transactions, right? But now what is what is also being applied with this technology is also on unstructured image or unstructured form. So the accuracy of it is very important because previously it may be like a 95% of accuracy, and scanning an invoice, for example, to take 10 information from there with 95% accuracy times 95% accuracy. So the overall accuracy or confidence level of it may goes down to below 60%. But right now, like for example, you see Xero is actually an accounting software which partners with Clipper. So they can actually do an OCR scan on an invoice and achieve over 99% of accuracies from there. So these are the things that, and at the back, digitalize the information, posting, and automatically reconciling for the SME, for the company as well. So all these some of this AI use case in the sector right now that I think is interesting to observe. There are definitely more new things, new topics that is coming along the way. Yeah, and yeah, but I will stop here. And yeah, so let me just pass this on back to Phoenix. Yeah, I hope what we shared is interesting to everyone. Thank you.
Thank you very much for all our speakers. So we will have the panel discussion for now. So maybe Ismail, would you mind to chair the panel discussions?
Right, thank you all. It's been illuminating for me to hear all these wonderful developments. I have questions for each speaker, and I'll start with Eric. I mean, what a wonderful infrastructure you are creating in that region, Eric. Is quite imaginative and comprehensive. Obviously, the how it is embedded in a digital economy is very important. My question to you would be, especially those listeners, students, to always, MBA students, they always want to get something that will give them an edge. I mean, you mentioned about, for example, the number of unicorns increasing, and then you have a large number of fintech. Could you tell us whether there are certain attributes with those successful fintechs that make them stand out and make them unicorn? So what would be the success factors from your experience?
Sure, Professor, thanks for the questions. Okay, so fintech, right, it's a little bit different from other startup that we see, is because fintech works in a highly regulated environment. As I mentioned, we have to work so closely with all the regulators in the back-end finance sectors, including Hong Kong Monetary Authority, the Securities Future Commission, all these, right? And hence, people in the fintech startup that we see is typically in the more successful one. They have very experienced bankers or investors with banking experience as on the board or as advisors. So we see the kind of support that they need is, apart from, opening doors, for solution adoption of the fintech innovation or investment they needed for scaled up. These are, typical for any startup. What they also need in fintech is the domain expertise. They need to speak the same language as the regulators. And what we're trying to do here is also be the bridge, to those regulators, so that we organize, informal lunch networking so that they can actually have a chance to speak to regulators directly in a less formal way. And also what we have also done is we created an environment of playground, or what we call the Fintech Sandbox. Not the regulatory sandbox, but just a sandbox to test things out so that they create, kind of new product or new innovations in the banking and finance sectors. But then at the end of the day, they still have to go through the same regulatory sandbox before they can really get to the market. So yeah, probably that's what I have read. But then probably the last thing I want to say is, for any fintech company or any startups who has the aspiration to become a unicorn, Hong Kong is just too small a market. All right, so that's why I mentioned about the kind of the market access to Greater Bay Area with the 9 cities plus Macau and Hong Kong is a good starting point, to expand out of Hong Kong after you've proven your success in Hong Kong, and potentially to bring that also to other parts of the world. That's very important. And that with that, you also need regulatory understanding of different geographies. And that's probably my advice to people that have interest to get into the fintech business. Thank you.
Thank you, Eric. It's been very insightful for those who consider future in fintech. Patrick, I mean, you've been doing banking. You mentioned last time we were in the same classroom, it was 20 years ago. And as someone who comes to Hong Kong and increasingly to China, Shanghai, 20 years has been a huge transformation. Each time when I come, especially, Shenzhen, which, with Hong Kong so close, the way the Shenzhen has developed. But I've always been struck by the infrastructure, because, we talk about digital finance, artificial intelligence, but the infrastructure, that border between Hong Kong and Shenzhen, I was always, amazed how quickly so many things move efficiently. It's amazing. So obviously with banking, finance, for that kind of infrastructure, we talk about the real economy. They've been very important in that development of that region. Bringing back to the discussions we are having with, and then you talk about the transformation of banking, reacting to the challenges on the digital side, because in banking, we always made a distinction between transactional banking. I'm sure you suffered from that, and relationship banking. And then banks have invested a lot in relationship banking. So do you think with all these digital technical, is it disappearing, or is there a competitive edge, trust and relationship banking?
Thank you. It seems that nothing's changed in the last 20 years, and your questions are still as difficult as they used to be during class. Look, no, relationship banking remains. However, within banking, the complexity is how the wallet has changed during that time. Okay, so if you think about what from a relationship banker perspective, you are the nexus between the customer and the rest of the bank. So you have that interlocutory role. Now within that, you've got a number of product areas to essentially form that relationship, which is essentially the total customer wallet at the end of the day. So you may have transactional banking, as you say, which is essentially deposits. I'll keep this simple. So deposits and, say, trade finance. And then you've got loans, and then you've got all the stuff you do in markets around FX, interest rates, debt capital markets, sometimes equity capital markets if you have that product, and then maybe advisory as well. Okay. Now, 20 years ago, when you looked at that wallet, it was very different. You could make decent returns, and I'll talk now from a large corporate and an institutional perspective. You could make decent returns lending money. These days, it's very difficult with the advent of quantitative easing. It's to sit here and say it's challenging to make money lending money. An outsider to the industry may think that's crazy, but that's what quantitative easing has done. It's compressed the returns. When you look at certain parts of markets which were far more profitable before platform trading came in, some time ago, they were cash cows. They're no longer cash cows. So, you may have made a certain spread on a foreign exchange transaction a number of years ago, where now you're making a few pips because it's basically on a platform. You're then now having quite a bit of pressure on transactional finance, in particular in terms of payments, because we've seen the way that's gone with the industry, in terms of supply chain finance with new entrants there and what that has done, and some of the innovation there, which has been really positive as well. So on and so forth, right? So the way the wallet is, the wallet and the revenue flows from each part of those wallets have changed. However, it's the job of a banker to deal with those changing times and to deal with the changes in the wallet and to be able to construct a win-win relationship between the customer and the bank. And essentially, that's what bankers get paid for at the end of the day. Where it gets difficult is the fact that it keeps moving. It keeps moving around. It moves around with structural trends towards whether it's digital disruption or new entrants, etc. And then you've got cyclical trends with the move of the interest rate cycle, credit cycle, so on and so forth. So look, I'm making this sound maybe overly complex and overly difficult. It's a wonderful role. It allows you to flex so many different muscles. It allows you to build really fulfilling relationships with customers. And it's not for everyone, but for those who want to thrive on that, it's a fantastic job.
Great, because we teach MBAs. So we offer a wide range of skills and management, HR, as you rightly said, the challenges remain there, but a banker's role is not purely sort of technological, but broader, which I think, like what Eric said as well, with the success factors, it is who you listen to, how you bring the experience is important. Because sometimes when I meet new students or enthusiastic entrepreneurs, they are brilliant with technology, but sometimes they can ignore some of the important aspects because finance is about financial decision making, learning from experience, managing relationship. That's why you come to an MBA.
Well, if I may add to that, it's really interesting. That's why I said some of the skills that you need to be successful in finance these days, that last bit, I said it's, language skills, cross-cultural skills, and soft skills as well. Because particularly if you're interested in investment banking, institutional banking, or large corporate, you need those skills. And that's something that when you look at the diverse range of subjects that we studied in the Manchester MBA, and the fact that you're working in team environments and pods, you get to develop the technical skills, but also a lot of the soft skills that you need as well. And I think that's the benefit of, say, an MBA versus a CFA, which is extremely highly technical, but you don't get a lot of those soft skills along the way because you're essentially just, maybe just studying yourself. So that's where I think the benefit of a classical, albeit progressive MBA comes from.
Right, thank you. Right, I'll move on to William. I hope, William, you don't create a robot teacher yet. I don't want to lose my job.
Not yet, yeah.
But having said that, I need your skills to make myself more productive. Yeah, because I mean, like what I'm doing now is talking to you, Eric, Patrick, and other people. So technology increases efficiency and then productivity. And then with COVID, I realized that I've been more productive because I have internet, I have the technology. I mean, like, I would, for example, love to have an artificial intelligence to do the marking for me. So put all my data, increase my efficiency. But also, I mean, access to information, because increasingly the world is becoming more complex for research. I mean, I find, using technology and artificial intelligence, even for research, extremely important. And then you've shown excellent use cases where efficiency improves in finance. Now, one question is, I mean, these things don't come cheap, because I think one of the reasons why banks lag behind technology, because it's always expensive and they have this cost-income ratio to manage. So, I mean, how do you see, I mean, the cost of introducing artificial intelligence to the full scale? I mean, is it something to consider, or is it creating efficiencies and cost reductions that compensate that investment?
Yeah, thank you, Professor Ismail, for your questions. Yeah, so yeah, definitely, yeah, we can't build robots to replace you. Yeah, because I still remember. Yeah, so also relevant to the questions, I still remember one of your saying, to actually build an AI or to make it intelligent, you need to train it. It's not just getting a software. You need to train the robot, and we are talking about millions of data. So it's not simply getting the technology and that's it. So I would say that banks traditionally, or the larger corporations traditionally, they may be seen as they are less innovative, or they are not very aggressive into like going full blown into all this AI technology, because previously they may have to build all those in-house, and that will means pretty much high cost. And talking about the potential returns that they may be able to see from there, it is not just appealing in the old days. But right now, what is being observed, actually, I think what was also discussed by you in the last 10 years, and especially after the financial crisis, a lot of these technology companies, fintechs, software companies have just boomed up, and they are taking the investment because there is all this QE, quantitative easing. They are able to take all this funding and investments to invest on the technology. And what does that mean is that a lot of these companies, a lot of these fintech companies came up, they mature, and is now able to, and that is important because they are able to scale their technology, and they are able to share or sell a finished products to a bank and teach them, guide them, how are you going to train your robots? How are you going to train your AI, your system? And that is important because talking about building something from scratch out, thinking about how to train your robot, what kind of data, what is the clean data, what is the structured data that you need to feed into the robot so they can make intelligent decisions. All these learnings, and that takes years, but with partnership with fintechs, and actually a lot of banks are practicing right now, and previously it may be just a strategy, but now it is really the putting into practice, that they are actually going out, looking at different fintechs, accessing their different technologies, pulling them back into accessing what kind of use case that the fintech can value add to their own environment, and therefore at the same time gaining such kind of technology, not just AI, but gaining such kind of technology at a lower cost, as well as bring the value add to there. So I think we are seeing this trend along the way, and not just the banks, even like the traditional larger fintechs like Visa, the company that I work for, they may be seen as the larger fintechs, And actually behind the scene is a technology company that facilitates financial transactions. And it is also putting a lot of investments, sourcing out a lot of those fintech companies, trying to expand the ecosystem, trying to secure what they can achieve in the environment itself. Yeah, so I think, yeah, definitely exciting with, like, for example, we have Eric and all, yeah, bring in and grooming all these fintechs to a certain state, and that is actually a chain that feedbacks into the whole industry itself, that brings up more cost efficient solutions to the whole industry itself.
Yeah, I mean, yeah, great explanation, William. I mean, the ecology, ecosystem, I think, is key, and it is something that Singapore is doing very well there, like Hong Kong. It is how you have that benefits of ecosystem of banks and fintech companies. Right. Okay. Well, thank you all for your comments. Over to you, Phoenix. So we have Q&A, I believe, next.
Yes. So thank you very much. So due to the time limit, so we can only answer 2 questions first. So we have 1 question for Ismail. So how do we manage sustainability against profitability, as most digital startups require you to take risks, as most unicorns are still not profitable in their nascent stage?
Okay. Well, that's a great question, because I mean, I talk about the business model, and then for a startup, it does take time. I mean, that's why you need venture capital. Yeah, venture capital is for long term. But so it needs to support, but you cannot support a business for forever. So at least there has to be a clear business model where the profitability will come. But that's why you need venture capital, risk capital, and that's why in my slide I showed how US and increasingly China with Shanghai, Hong Kong, and then Shenzhen together can raise venture capital. And then Hong Kong, I think, has been very influential in that sense, given this history. So it's not an accident that successful fintech companies come from China and Hong Kong, and then Singapore too is where you can attract venture capital, and then US is very good. So that's a clear disadvantage of European Union. London is better, so that's why again UK is better in fintech, because in London you have venture capital, but it's something that Europe is lacking. I mean, there are excellent fintech companies in Europe in individual countries, but Europe has never created a Eurozone-wide risk capital. So yeah, risk capital, venture capital, but there is some venture capital you got to be careful about. They want to make a return in 5 years in financial terms. So I think we need to be careful that venture capital is going to be with you for 10 years. I mean, that's why after COVID, some fintech companies found it difficult because venture capital has been hesitant. So we want real venture capital looking for 10 years rather than taking a return in 5 years. So that would be my answer.
Thank you very much. So we have 1 question. So do you see a potential reversal in growth of ESG stocks as outside of the disruptor like Tesla? So other ESG stocks which are focused on renewable, such as wind and solar, and currently provided lower return on the capital invested. So for example, energy provider building wind farms have low IRR projections and work to long timeline for seeing ROI. How is this sustainable when actual returns are so low? So I see Patrick would like to answer these questions. So would you please?
Yeah, sure. Thank you. I'll answer this in two parts. So firstly, I don't see a reversal in ESG at all. We strongly believe we've essentially reached an inflection point. The proof points of that is the US re-entering the Paris Agreement. If you look through China's latest 5-year plan, you'll see a heavy emphasis on ESG, or at least sustainability in the environment. You see it in the way that banks are or not supporting certain industries, for example, like thermal coal. You see it in the number of times sustainability has been raised in today's discussion, albeit we're talking about digital disruption and the future of financial services, right? So they're all proof points. It's interesting that a couple of years ago, we as a bank used to look at sustainable finance as a kind of a vertical and a product. Now it's becoming more horizontal. It's being inculcated into pretty much everything that we do. Consumers are demanding it, our customers are demanding it, investors are demanding it, our employees are demanding it as well. So all of our stakeholders are. And we're seeing phenomenal growth in sustainability-linked loans, green loans, sustainable supply chain, green bonds, so on and so forth. Now, to your point on tenor and returns. Now, tenor really should not be a barrier for certain transactions, and the type of transactions you're referring to below, generally speaking, would be well suited to project finance, where you can have 15, 20, well, you can 10, 15, even longer tenors for those types of transactions, as long as the transaction is appropriately structured. So you've got a reputable operator, an EPC contractor with a track record, and you're not taking what's called merchant risk or off-taker risk or price risk. And so you can basically wrap that all up in a standalone transaction. And again, banks have been supporting those transactions for double-digit years. The other thing I would say around the risk and return is this, and particularly from a sustainability perspective, the way we look at sustainability is a sustainable business is essentially a business that's operating sustainably, has higher resilience. Higher resilience, generally speaking, means lower risk, and risk is correlated with returns. So from both the structuring perspective from project finance and in terms of sustainability from an overarching standpoint, those two things would allow you to do long tenor transactions at lower returns than what you would normally see. Hope that answers the question.
So thank you very much for all the speakers for the very fruitful and informative section of and your insights. So I will now pass the stage to Jocelyn, our colleague from the Singapore Center. So Jocelyn. So I think Jocelyn might need to unmute yourself.
Sorry. Okay. Thank you so much, everyone. Professor Ismail, Eric, Patrick, and William for the wonderful presentations and discussion. Digital disruptions has indeed transformed the ways things have worked and redefining the entire finance ecosystem, turning it more diverse than ever. The future of finance and the immense opportunity ahead is just amazing. There's no better time to capitalize on the opportunity for both finance and non-finance professionals to take action and be the part of this exciting journey ahead. Whether it's banking, finance, fintechs, financial institution, regulatories, payment system, or AI technologies innovation, we hope that today's sessions have given you a glimpse of the industry and the exciting opportunities ahead. For those who actually would like to pursue your career inspiration in this area, may want to check out our MSc in Financial Management next intake joining September 2021. This program is a joint collaboration between Hong Kong and Singapore Center, meaning that you'll be studying alongside with classmates from Asia from the top 2 financial and technology hubs in Asia. where you can expand your networks and opportunity while studying. So our MSc Financial Management program equips you with deep understanding of the tasks financial professionals undertake, the skills required for successful careers in finance. This is a well-balanced program where you cover modules from fundamentals of finance and accounting, business management and strategy, where you look at global financial markets and institutions, international finance management, venture capital and private equity, and business modeling and financial strategies, rounding out with a quantitative analysis of tools and techniques and a finance research project to give you a holistic understanding of the industry. Feel free to contact my colleague Venus from Hong Kong Center or myself, Jocelyn from Singapore Center, to find out more about the program. Before we end this section, we will appreciate if you kindly take 2 minutes of your time to do a quick online survey to provide your feedback so that we can do better next time. Last but not least, we'd like to thank all of you today for attending our session this evening. We hope that you have some takeaway from these insightful presentations and discussion, and we look forward to see you again next time. Feel free to reach out to us if you have any questions. Thank you once again, and good night.
Thank you.
Thanks, everyone.
Bye, everyone. Thank you.
Thank you, everyone.
Bye.
Thanks all.